While everyone was glued to their phones watching the Middle East erupt, something extraordinary was quietly happening in the XRP market. And I don't mean extraordinary in a bad way. I mean extraordinary in a way that, if you understand the mechanics of what I'm about to walk you through today, is going to completely flip the narrative you've been fed by every major financial outlet. Because here's the question I keep getting from you, over and over, in my comments, in my DMs. If the world is on fire, if oil is spiking, if inflation is coming back, why hasn't XRP fallen off a cliff? That is the right question. And the fact that you're asking it tells me you're already thinking a level above the crowd. The answer to that question is going to take us deep. We're going to talk about oil. We're going to talk about the Strait of Hormuz. We're going to talk about what Jerome Powell is about to be forced to do and how that historically plays out for XRP. And then, and this is the part that nobody is connecting right now, we're going to talk about why a global monetary crisis is not XRP's enemy. It is, when you understand the underlying architecture, XRP's most powerful argument for existing in the first place. The world just handed XRP the most compelling use case demonstration in the history of the asset, and the crowd completely missed the signal. Let's go. Welcome back. If you're new here, this channel is not a hype machine. We don't do moonboy price calls. We don't do panic sell videos. What we do is slow down, look at the data, understand the structure, and make decisions from a place of clarity rather than chaos. Today's topic demands exactly that. Let's pull back the curtain on what's actually happening right now and why the informed investor is not watching the news cycle. They're watching something else entirely. Let me start with the hard truth. 90% of people watching the current geopolitical situation in the Middle East are asking the wrong question. They're asking, is this bad for crypto? And yes, on a surface level, the logic seems bulletproof. Strait of Hormuz gets choked. 20% of global oil supply gets disrupted. Oil prices spike. Inflation runs hot again. The Federal Reserve is forced to halt rate cuts, maybe even reverse course and hike. Risk-on assets get crushed. Crypto dies. That's the story being told. That's the story getting clicks, and it is not the whole story. Here's what you need to understand first. The cryptocurrency market, and specifically XRP, did not wait for you to read the news. The market is not a newspaper. The market is a forward pricing machine. And the forward pricing machine had already been digesting the probability of this exact scenario for the better part of 5 to 6 months. Look at the data. XRP corrected close to 64% from its peak before this situation fully broke into mainstream headlines. That is not a coincidence. That is not retail panic. That is the market's way of saying, we see this coming, we are pricing it in, and we are building a base at a level that already accounts for this risk. Exchange reserve data, and you can pull this from CryptoQuant yourself, has been showing a sustained multi-month drain of XRP off centralized exchanges. That means holders are not panic selling. They are withdrawing into cold storage. That is a structural behavioral signal that is completely opposite to what you'd expect if the market were genuinely terrified. Now, the second thing I need you to understand, and this is where it gets critically important, is the mechanism by which higher oil prices and inflation actually interact with a system like XRP. Because XRP is not a store of value play. It's not digital gold. It is not Bitcoin. It is not a bet on scarcity. XRP is a bridge currency. It is designed to move value across borders, across currencies, across financial systems, faster, cheaper, and with less friction than anything that currently exists. And what does an oil price shock do to global cross-border commerce? It massively accelerates the urgency to find a more efficient system. Think about this logically. When oil prices spike, every single cost in the global supply chain goes up. Shipping gets more expensive, manufacturing gets more expensive, importing gets more expensive, and suddenly, every basis point of friction in the global payment system becomes a cost that someone, somewhere, is desperately trying to eliminate. The $27 trillion sitting in Nostro and Vostro accounts, trapped, idle, inefficient capital that banks are forced to pre-position around the world just to settle cross-border transactions, that $27 trillion becomes even more of a problem when the underlying cost of doing business is going up everywhere. The world just made XRP's pitch for it, and there's more. Because the geopolitical dimension of what's happening right now goes deeper than just oil and inflation. When the Strait of Hormuz becomes a pressure point, it forces a very uncomfortable global conversation. It forces sovereign nations to ask, how fragile is our financial infrastructure? How dependent are we on a system that can be disrupted by a single choke point in global shipping? How exposed are we to the dollar-denominated settlement layer when geopolitical fault lines are shifting this fast? That conversation, the one happening in central banks and finance ministries right now, is the exact conversation that leads to cross-border settlement reform. And the infrastructure that is best positioned to answer that question is the XRP ledger. Let's do the math, because this is where the story stops being conceptual and starts being irrefutable. The global cross-border payments market processes approximately $150 trillion annually. That is not a small number. That is not a niche market. That is the backbone of global commerce. And the current system, SWIFT-based, correspondent banking, nostro vostro pre-funding, processes that $150 trillion with an average settlement time of 1 to 5 business days, fees ranging from 2 to 5% on smaller transactions, and, again, $27 trillion in pre-positioned capital sitting idle just to make the plumbing work. Now let's look at the Forex market. $7.5 trillion moves through the foreign exchange market every single day. Every single day. That's not annual, that's daily. The inefficiency tax on that $7.5 trillion daily flow, the spread, the settlement delay, the counterparty risk, is extraordinary. We're talking about hundreds of billions of dollars per year in friction costs baked into a system that has not been fundamentally redesigned since the 1970s. Now here's the math that the retail crowd consistently ignores. For XRP to function as an effective bridge currency at the scale of even a fraction of that market, let's say 5% of global cross-border volume routes through the XRP ledger, you are talking about $7.5 trillion annually moving through a system with 100 billion tokens, roughly 55 to 57 billion of which are currently in circulation. Here's what that means for price. The liquidity requirement, the amount of capital that must be held in XRP at any given moment to facilitate that level of throughput, scales directly with the price of the asset. This is the concept of the liquidity bridge. A higher XRP price means fewer tokens are needed to bridge a given transaction. It reduces slippage. It increases efficiency. And it means that for the system to function at institutional scale, the price of XRP is not just a number on a chart. It is a functional variable in the math of global settlement. Think about that carefully. This isn't a prediction. It is a design requirement. Now let's layer in the current macroeconomic environment. We just established that oil prices are likely to spike in the near term. We established that this creates inflationary pressure. We established that this potentially forces the Federal Reserve's hand on rate cuts. Now let's think about what that does to the dollar. When inflationary pressure returns, real yields compress. When real yields compress, the dollar weakens. When the dollar weakens, dollar-denominated assets face headwinds. But here's the interesting flip. Assets that are not denominated in dollars, assets that represent a claim on a utility rather than a currency, those assets have historically been where capital flows when dollar confidence wobbles. Sound familiar? The tokenization wave, which BlackRock's Larry Fink has publicly projected could reach $4 trillion in tokenized real-world assets within the next decade, does not run on a weakening dollar. It runs on a neutral, efficient, globally accessible settlement layer. And the XRP ledger, with its sub-second finality, near-zero transaction cost, and existing institutional infrastructure, is the only public blockchain that has been specifically designed and legally positioned for that role. And here's one more number I want you to sit with. The derivatives market, the total notional value of outstanding global derivatives contracts, is estimated at $1.2 quadrillion. That is not a typo. $1.2 quadrillion. The settlement layer for a portion of that market alone would require a bridge currency with a market cap that makes today's XRP price look like a rounding error. This isn't speculation. The math demands it. Now, I understand that math is compelling, but math lives in a vacuum until you see the behavioral evidence. So let's look at what the smart money is actually doing right now, because the contrast with retail behavior is stark. While retail investors are asking, Should I sell? And debating whether this is the beginning of a global collapse, the institutional infrastructure around XRP has been quietly, methodically, relentlessly expanding. Start with Ripple itself. In 2024, Ripple acquired Standard Custody and Hidden Road, a prime brokerage firm that services over $3 trillion in annual transactions. You do not acquire a prime brokerage if you are building a toy. You acquire a prime brokerage when you are preparing to operate at institutional financial infrastructure scale. Then look at the regulatory dimension. The Digital Asset Clarity Act has been advancing through Congress. The legal cloud that hung over XRP for years, the SEC litigation, has effectively been resolved in XRP's favor on the most critical question of whether secondary market sales constitute securities transactions. That was the gate. That was the question that kept institutional capital on the sidelines. That gate is now open, and the institutions are walking through it. The spot XRP ETF applications that are now in the pipeline with the SEC represent something beyond just another investment product. They represent the formal integration of XRP into the regulated financial product ecosystem. Ask yourself this: does a firm like Fidelity or Franklin Templeton or any other multi-trillion-dollar asset manager file for a spot ETF on an asset they don't believe has a long-term future? Absolutely not. They do not gamble with their regulatory standing. They do not take reputational risk on assets they aren't certain about. They position quietly before the crowd catches up. Meanwhile, the Bank of Japan, whose partnership work with Ripple on cross-border payment infrastructure represents one of the largest sovereign validations of the XRP ecosystem, is sitting in a fascinating position right now. The yen has been under extraordinary pressure for months. Japanese monetary policy has been one of the most closely watched variables in global macro, and the institution at the center of that geopolitical monetary moment has a formalized working relationship with the infrastructure that XRP runs on. Coincidence? Or architecture? And then there's the on-chain data, which is where behavioral truth always lives. Exchange reserves for XRP, tracked by Glassnode and CryptoQuant, have been declining for months. Long-term holder metrics are strengthening. The ratio of XRP held in self-custody versus exchange custody is improving. These are not the behavioral signals of an asset in distress. These are the behavioral signals of an asset being accumulated by hands that do not intend to sell at these prices. While the crowd panics at the headlines, silent actors are positioning. That is the story the data is telling, and data does not lie. Now let's talk about what comes next, because understanding the thesis is only half of the equation. The other half is the sequence of catalysts that transforms thesis into price action. Here's what I'm watching. First, and this is the near-term variable, oil and inflation resolution. My view, and I'll walk you through the historical data that supports it, is that the current geopolitical escalation in the Middle East is more likely to resolve faster than the mainstream narrative is projecting. History is instructive here. Markets tend to price geopolitical risk at its most extreme during the period of maximum uncertainty, not at the point of maximum actual damage. The Venezuela parallel is apt. These situations, as catastrophic as they appear in the acute phase, have a consistent historical pattern of resolving faster and less severely than the doom scenario assumes. And when the resolution comes, when the Strait of Hormuz pressure eases, when oil pulls back, when the inflation spike proves transitory, the Federal Reserve will resume its rate-cutting cycle. And the monetary tailwind for risk-on assets, and for XRP specifically, will return with force. Second, and this is the medium-term catalyst, the ETF approval timeline. The SEC, operating now in a dramatically more crypto-friendly regulatory environment, is working through multiple spot XRP ETF applications. This is not a maybe. This is a process underway. And when spot ETF approval lands for XRP, the institutional on-ramp that opens is not comparable to anything that has happened to this asset before. We saw what spot ETF approval did for Bitcoin. XRP has a fundamentally stronger institutional utility argument than Bitcoin, because XRP is not just a store of value play, it is a payment infrastructure play. And institutions that need to justify an investment to compliance departments love utility arguments far more than scarcity arguments. Third, and this is the long cycle, the global reserve currency conversation. The geopolitical fragmentation we are watching right now is accelerating a process that was already underway: the de-dollarization of portions of global trade. As sovereign nations and emerging market economies look for dollar alternatives, not to replace the dollar, but to reduce exposure to single currency settlement risk, the demand for a neutral bridge currency explodes. XRP's positioning for that role, with legal clarity in the United States, institutional relationships globally, and a proven settlement infrastructure, is unmatched. The fuse is lit. The question is simply how long the fuse is. Here's something the crowd never focuses on until it's too late. XRP exchange reserves have been at or near multi-year lows. Every month, Ripple releases 1 billion XRP from escrow, and the vast majority of that is relocked. The effective liquid float of XRP is significantly smaller than the headline 55 to 57 billion circulating supply implies. And that liquid float is being quietly absorbed. When the retail investor finally shows up, and they always show up eventually, usually after price has already moved, the available supply will not be where they expect it to be. The exchanges will not have inventory at current prices. And when demand hits a constrained supply, the price discovery that follows is not linear. The window to accumulate at a price that reflects maximum uncertainty, the oil spike, the inflation fear, the geopolitical noise, is not infinite. These windows in historical markets have been notoriously short. And once the catalyst sequence I've outlined begins to execute, rate cut resumption, ETF approval, institutional integration deepening, the price will not wait for you to feel comfortable. The door is closing. Not in a panic way, in the quiet, inevitable way that markets always work when the structural positioning has already been done by those who are paying attention. I want to take a moment here and speak directly to the person who's been in this for a while and is feeling the weight of the current environment. You have been patient. You have watched the market move against you. You have watched the news cycle make it feel like every month there is a new reason the thesis is broken. Iran, inflation, interest rates, SEC, it is relentless. And it is designed, not by malice, but by the simple economics of media, to make you feel like you should act. Like sitting still is the foolish choice. But here's the thing. The investors who made the generational wealth in every previous macro cycle, the dot-com recovery, the 2009 rebound, the 2020 rebound, every single one, were the investors who had already done the work before the catalyst hit. They understood the structure. They understood the math. They held through the noise. And when the crowd finally caught up to what they already knew, the price reflected it. The question is not whether this plays out. The question is whether you are the one holding when it does. The informed investor does not react to the news cycle. They build a thesis. They stress test it. They hold it with conviction. And they let time and math do the work. Now, I want to be honest with you, because credibility means engaging with the bear case. The legitimate concern here is duration. If the Strait of Hormuz situation drags on for months, if oil stays elevated, if inflation reaccelerates materially, if the Fed is forced to reverse course and hike rates, the macro headwind for all risk assets, including XRP, is real. A high interest rate environment is not a favorable environment for speculative assets, full stop. And anyone telling you otherwise is selling something. The second legitimate concern is that institutional adoption, while directionally clear, is not instantaneous. ETF approval, ODL volume scaling, central bank integration, these are processes that move on institutional timelines, not retail impatience timelines. There is a real gap between where the infrastructure is today and where it needs to be to manifest the mathematical thesis I've described. These are real risks. I am not dismissing them, but here's how I weigh them. The infrastructure being built around XRP right now, the acquisitions, the regulatory clarity, the ETF pipeline, the sovereign partnerships, is not infrastructure being built for a market that fails. You do not build this level of institutional architecture as a hedge or as an experiment. You build it when you are certain of where the world is going. The institutions building this infrastructure are not wrong. And the duration of the current macro headwind, as uncomfortable as it feels, does not change the destination. It may change the timeline. It does not change the math. Let me bring this home. The world is in the middle of a genuine geopolitical and macroeconomic shock. The Strait of Hormuz, oil prices, inflation risk, Federal Reserve uncertainty. These are real. They are not trivial. And anyone who tells you the market can just ignore them is not being honest with you. But here's what I know. Every single time in the history of modern markets, inflation at 40-year highs, wars starting, pandemics erupting, governments shutting down, the investors who preserved and grew wealth were the ones who understood the structure beneath the noise, who understood that the market's job is to price in uncertainty before the crowd sees it, who understood that by the time the news is screaming doom, the bottom is usually already forming beneath your feet. XRP is not a bet on the world staying calm. XRP is a bet on the world needing a better financial system. And that need does not go down during a crisis. It goes up. The thesis is intact. The math is intact. The infrastructure is being built. And the window to hold conviction through the noise is one of the most valuable windows in this entire cycle. Stay informed, stay rational, stay positioned. If you found value in this breakdown today, I want to see it in the comments. Drop the word bridge below if you made it to the end. I want to know who is actually doing the work. And if this channel brings you the kind of analysis you can't find elsewhere, subscribe. We are building a community of investors who think before they react. I am the calm analyst. And as always, the math doesn't lie. The system is being built, and the world just proved exactly why we need it. See you in the next one.